As folks are coming into the room, I'll say good morning or good afternoon, depending on where in the world you're signing in from today. I know it was a bit of an international audience, so really appreciate everybody's time today. I'd love to welcome you all to a very special sixth webinar featuring Wallbridge Mining's management and team to discuss the recently published PEA on the Fenelon Gold Project in Quebec's Abitibi. There will also be joining us today. We're lucky enough to have a couple of external consultants who worked on the study. With us today from Wallbridge, we have Brian Penny, CEO, and Mark Peterson, Senior Geological Consultant. We also have Mike Mayhew, founder of Mayhew Performance, along with Pierre Roch of Roch Engineering. Let me tell you how today's going to work. So the format of today's webinar is going to be a 20-ish minute presentation delivered by Wallbridge, to be followed by an interactive discussion with the team. So I've got some questions that are built to some degree from the questions you already submitted via email, which I'm very appreciative for. But then we'll jump into live questions from the investor audience here in the room today. There's a chat button in the bottom right-hand corner of your screen. Please use it at any point during today's presentation. You can ask questions, and we'll try to get to as many as possible. If for whatever reason we don't get to your question, hope we do. But if we don't, I'll make sure the Wallbridge team gets all your questions, so they'll get back to you as soon as possible. Today's event is also being recorded, and it will be available for replay in the early afternoon Eastern time. So keep an eye out for that in your inbox. But before I turn it over to Brian and Mark, who I think folks on six webinars are familiar with, Mike and Pierre, I'd love if you could give us a brief introduction on yourselves and your roles as advisors in the PEA. Pierre, I'll start with you if you don't mind.
Sure. Pierre Roch, mining engineer since 1986. Worked in northwestern Quebec, actually not too far away from where Fenelon is located. Then moved on to northwest Ontario, BC, South Australia, and then back in Oakville, where I've been freelancing for the past 6 years. I did receive a call from Brian a little while ago to assist with the delivery of this PEA. So here we are.
Awesome. Thanks, Pierre. Mike, I'll throw it to you for a quick intro.
Yeah, good morning, everybody. Mike Mayhew, founder of Mayhew Performance, mining engineering, specialize in PEA studies as well as M&A and operational readiness, such as Pierre. Spent some time in the operation. I was part of the Kirkland Lake Gold team, also heavily involved with Discovery Silver, and worked in Chile and Mexico, and joined the team here with about a month and a half ago, and going over helping Brian and the team for Wallbridge. So thank you.
Awesome. Thanks, Mike. So let's get into the protein of today's event. Brian, I'll throw it to you for the presentation.
Thank you very much, Romeo, and thanks for all out in cyberspace that are attending. We appreciate you joining this update session. It's a very exciting time for Wallbridge, and we're pleased to share this information with you. Just a little bit on Pierre and Mike. I'm a CPA, as you all know. I'm not a technical expert. So Pierre and Mike are not QPs on the file. I hired them as an independent person to work with us to review, and with their experience, particularly in the Porcupine area, in Kirkland Lake, in the Abitibi, they had a great knowledge base to draw upon, just to make sure that everything going into the study looked reasonable. So a little bit of background on that. On page 2, we start off with our cautionary notes, and then, of course, we have our QP statements and some non-GAAP measures that we have to reconcile to, so they're there for you to review at your leisure. Moving on to page 4, this slide is common to our decks. We're in the northern Abitibi. You can see past production since the 70s, about 15 million ounces. Southern Abitibi is over 200 million ounces. Great geology, great location. We're seeing the same geology as the south. However, there's 10, 20, 30 meters of overburden that we had to plan and explore through to find what we have today. So, it is a bit remote, and as a result, it's a little bit behind the south. Our share structure as of today, you can see our trading ranges. Yes, we do have 1.1 billion shares outstanding, and we closed the year with about $21 million of cash in the bank. Biggest shareholders are Eric Sprott owns 15%, Agnico Eagle owns about 10%, and William Day Construction out of Sudbury owns about 5%, and they've been a shareholder for a very long period of time. Covered by two analysts, BMO and Paradigm. Here's our board. Tony is our chairperson. I'm the CEO. Brian Christie, he's the Agnico rep on our board, and he was a long-term analyst on Bay Street. Danielle's a professional geologist. Jeff is a lawyer. Michael is a retired partner from KPMG, and Janet is an HR specialist. So we've got all of the disciplines covered by our board, and our leadership team. Mark, he's a consultant, but he's our de facto VP Exploration. Mary's been with the company for 17 years. She's our CFO, and she's the steady hand we need in the room there. Tanya just joined us. We welcome her, and it's really fun to work with her. Carol runs our HR group, and then Guillaume runs our health, safety, and environment. He came to us from Rio Tinto, a great addition to the team, and Sean's our corporate secretary. A little bit of history for anybody new to the story. We started off buying a postage stamp property, 10.5 square kilometers from Balmoral for about $3 million cash. We explored it, and in 2019, we had the discovery of Area 51, Tabasco, Cayenne, and contact zones. In 2020, we liked what we saw so much, we did a capital markets transaction and acquired all of Balmoral. 25 years ago, Wallbridge started off as a nickel explorer in the Sudbury Basin. We had a bunch of properties in Sudbury, which we divested from, so we can be totally focused on gold, totally focused in the Abitibi, and with one very large property of 830 square kilometers, there was, by divesting of the nickel assets, there's no question what our focus was going forward. Earlier this week, yesterday, we published a new resource report, for the Fenelon and Martinier projects. The numbers are on the screen right there. And included was an updated PEA on a 3,000 ton a day scenario. We're running it at $2,200 gold. Just so happens that's $900 below spot price as we speak. Good economics, good annual production. In the first 5 years, it's up to 127,000 ounces a year. Very quick payback, 4 years at 2,200 gold, and at the $3,000 scenario is 2.5 years. Initial capex is down a little bit from the last study, but the life of mine capex, including sustaining capex, is down about $200 million, and a better after-tax IRR return than the last time. So digging a little bit more into those numbers, life of mine, 107,000 ounces a year. 120 million of free cash flow, initial capex of 579 million. We would have expected it to drop more, but we've taken a conservative view when it comes to the tailings management. We have put in a dry stacked tailings system and desulfurization because it's the right thing to do. And considering we're in the far north, it's a prudent way to manage it. So it did increase the cost, but overall it went down from the last study. And that's amazing considering, the whole study last time was put together at a, based on October 22 cost, because, the resources came out in January and, the PEA thereafter. So we've got more than 2 years of inflation. And, yes, it's a smaller size mill. The reason why we focused on this, less moving parts, it helps us better manage the permitting process. So we have to only deal with the Quebec regulators, and who knows where the permitting process is going in today's environment. But I think things are going to get more manageable, not more difficult. Great cash costs, good all-in sustaining costs. And this all-in sustaining cost is a clean calculation. Cash cost is based on your production costs. All-in sustaining costs, sustaining capital, and everything from commercial production going forward is treated as sustaining capital. So, there's nothing left behind. And then again, you can see the numbers. Our resources, I'm not going to spend a lot of time talking about this because Mark is on the line. We have an appendix to the presentation, which Mark will probably walk through. And, I'll turn it over when we start talking about Martinier. So I will just pass on this. Other than, the grade in this year's is higher than the one 3 years ago. Yes, there's less tons, but Mark can talk about, some of the geological constraints we've learned in the past 2 years and put into the model. Our PEA approach is going back to first principles. Pierre Rock, and he was a rock star in the process. He provided guidance, looking at, unit costs, saying, we whack this together, and you say, that seems a little high or a little low. And it was great to draw upon that expertise as we put this thing together. So we went to first principles. We used a Deswick stope optimizer. The mining method is transverse and long hole mining. We did various trade-off studies. The CapEx is all integrated. The power line costs a little less because it needs less energy at 3,000 tons a day. And, we did look around and see what others were achieving as far as unit costs. And as you know, I'm a CPA, and I like to run checks and balances and everything checked. And the picture you see on the right-hand side is the layout. We will not build a shaft at 3,000 tons a day. We do not need a shaft. In this process, we'll mine out about 52% of the overall resource. And at some point in time, you could look at an expansion opportunity. Ideal time would be after payback, but it all depends on what the gold price is, after payback, which could be, 6 or 8 years from now. So the phased approach, pre-production is year 1 and 2. We actually, in late year 1, most of year 2, we are working underground. There is some development in ore, so that material will be stockpiled. Then there's some early, stope mining. That material will be stockpiled. So by the time we get to the production by ramp in year 1, we've got a stockpile that gets us, 3, 4, 5 months of startup muck to manage the risks with starting up. And then, we ramp down at the end. One would say, why? You have this open pit opportunity. Why would you put it at the end of the mine life? Why wouldn't you start up with it? Well, the open pit is around where the portal is now. And we just don't want to jeopardize that if we start this, that something happens and we have to start a new portal. It's just looking at the risks and being a prudent operator. The power line is unchanged from last time. It's about 28 kilometers all in all. It connects us to the James Bay hydroelectric system. We need to advance those discussions, but we need a study to go to the next phase of those discussions. And we need to complete a pre-feasibility. So that ties into where to from here discussion. The surface infrastructure is there on a picture, as well as the camp. We're using all the stuff we have at the camp, and we're just expanding it to save costs of that. And then, the interesting thing about the waste rock management is we'll start off with a small waste pile. We will we material underground to backfill the stopes, and then it is a paste backfill as well. And sort of at the end of the mine life, the remaining material on surface, so that, is kind of like an overflow stockpile, will go underground. And so it helps us with our reclamation plan and all that work. And again, it's the right thing to do. Metallurgy hasn't changed, other than last time it assumed an underground crusher with a shaft in the early years of production. This year, the crusher will be on surface. Same recoveries, nothing's changed other than desulfurized dry stack tailings. The various cost components, you can see the initial capital of $579, sustaining capital of $449. You can see how we calculate our all-in sustaining costs and our cash costs. And, I think they're very well researched, and we're very comfortable with the end results. I love this chart. This is our annual production. In the first couple of years, our production is higher because we start off with that stockpile. So it helps us make sure that, as the mill starts up. We have built into it about a 3-month ramp up. There's plenty of material, and if there are any little hiccups underground, we've got it covered. So again, but the exciting part is first 5 years averages 127,000 ounces per year. And that helps us with the quick payback as well. There's your after-tax annual cash flow. It averages about $120 million a year. It drops off in year 15 and 16 because, that's when we get into the a small open pit at the end of the mine life. It makes sense to do it, but, it doesn't add a whole lot to the future, but it's a very simple, small open pit. I believe the strip ratio on that is 3-to-1, but there's a lot of runway between now and then as we figure that one out. This is the real exciting side, is our sensitivity to our internal rate of return, our payback period, and our NPV at various prices. Today we're about $3,100 gold. I think we're nominally over that just before I got on the call. At 3,000, the NPV is 1.4 billion, a 34% IRR, and a 2.4-year payback. Very, very exciting, and we have to figure out the path going forward. We have a plan for this year. We announced our plan in January to continue to explore Martinier. We need to take a bit of time after the study to scope out what exactly we need to do to take us to a pre-feas. Do some additional work on what resources do we need to do that, and come up with a plan, probably late this year on how we go forward. Some of the comparisons to the 2023 PEA, and I'm starting to run long, so very passionate about this, but I thought I'd provide this. Yes, the gold price is substantially higher. Yes, the exchange rate is in our benefit. What we did with the model is we've raised for the resource estimate, the cutoff grade is very similar. For the mining parameters, we increased the cutoff grade with the goal of mining the highest margin ounces in this plan. We wind up mining, and I know, you're not supposed to add the numbers together, but we mine and process, and again, this is a PEA. These are not reserves, these are resources, about 52% over the life of mine. So there is ounces left for expansion at some point in the future. So you can see, our cutoff grade is 2.25 grams and 2.5 for Area 51. That leaves us with an average mining grade of 3.34, a half a gram better than the last time we looked at this. Less tons mined. Mine life improves. And that's exciting being a financial guy, because if you're talking at the base price assumption of a 4-year payback, you've got, 12 years of tail after payback. So as you're arranging project financing and stuff like that, it's attractive for lenders. So, that's kind of cool. And there's your average annual production again. And the rest of the numbers, we've all talked about the IRR and other things. The team involved, MB Consulting, Mauro Bassotti, who I've known for years, is our resource estimate consultant. Vexplo or Nordest Stello dealt with the mine design, rock mechanics, all of the mining part of it, as well as the environmental and underground electrical infrastructure. G Mining supported us with the process design, BBA on infrastructure and tailings. Those are all QPs on the technical report. We filed the technical report yesterday morning as well, so everything is in the public domain. And then Mayhew Performance, Pierre and Mike, helped us. I call them as a third-party reviewer, helping us make sure that we haven't missed anything from the company side. So we have a hub to unlock a district scale opportunity. Our focus on exploration as Martinier. We need to figure out how this all fits together at some point in time. But to date, historically, you have 600,000 meters drilled at Fenelon. That's why we're advanced in at a study, and probably somewhere around 150,000 at Martinier. So it needs a lot more work to catch up. At some point in time, that could be considered, but first we need to drill. We have a nice after-tax NPV, strong cash flow. As you can see from the model, great leverage to gold prices, because the only thing that really changes in our cost profile is a royalty. A 4% royalty on $3,000 an ounce is more than a 4% royalty on $2,200 an ounce. We continue to de-risk it. We want to continue to advance the project. Can't have a better location to do business. The province of Quebec, with their refundable tax credit regimes and others, they've been very, very supportive. And we have opportunities as we electrify and get onto the James Bay power grid. This study is basically underground LHD, some electrical equipment, but we have to do additional work to see if we can maximize the benefit of our green power that's provided to the operation. With that, I'll turn it over to Mark, and he'll talk a little bit about Martinier, and then we'll come back and he'll walk through the resource table briefly, and then we'll come back to the Q&A period. Mark?
Okay. Yeah, thanks, Brian. And thanks, everyone, for joining us and taking the time to catch up with Wallbridge and all that we've got going on. We do have a lot going on. As Brian mentioned, our focus on the exploration front continues to be at the Martinier project. Last year, we drilled, I think, approximately 24,000 meters total across the entire Detour Fenelon gold trend, and the vast majority of that was put into Martinier. We're just picking up where we left off last year. This year, we have about 15,000 meters of drilling planned. Through the course of last year, we were putting out results. We put some out in midsummer and then in November for our phase 1 and phase 2 parts of the program last year. And one of the takeaways as we were moving through that program was that the Bug Lake trend, which is shown kind of in between those reddish pink dashed lines, that's really the center of action within this overall gold system. And what really impressed me along the way, I joined Wallbridge a year ago, so I was at the bottom of a learning curve then, but I've made a lot of progress forward, is that our program around Bug Lake, especially phase 2, we were stepping out around the known resources at the time on four targets, and we had positive hits on all four, which I was impressed by right away. But in particular, 3 of the targets, Dragonfly, Horsefly, and the Martinier North zones, which were in anywhere from 100 meters to up to a half a kilometer outboard of the defined resources from the 2023 estimate, we were getting positive hits. And it became very clear. Can we go to slide 24, please? It became very clear that this system is still, even though most of the drilling has happened up around the Bug Lake North, Bug Lake South parts of the system, it's very much an under-drilled, under-explored gold system. At Dragonfly, we had some positive results. We've had some initial gains with some resources. Those are outlined right under that label, Dragonfly area. Likewise, in the Horsefly area, we had some positive results. It's a little bit behind this section in plan view, but a little bit to the north, but also at Martinier North. So we just started drilling. We went back out there with the drills. Our field crews dug through 2 meters of snow to set up the first drill pad. And we're currently on our 3rd hole. That's hole 113 on Martinier North. We've got the first one down at hole 111. And then one in the gap in between Dragonfly and Bug Lake North resource, we've got hole 112. And these holes are still really within the upper 200 meters from surface. We do have plans to drill farther laterally outward along strike, but also, it's a results-driven program. But as we move along here more toward phase two, our intent is to start testing some of these deeper down plunge projections of the geology that we're seeing in the drilling. So very excited getting back out there to Martinier. And we do anticipate to be putting out the first results from this year's program later in Q2. I know we're a little bit pressed for time, but if we could just advance to the resource statement. Okay, this is the new mineral resource statement. It's a consolidated statement of our mineral resource estimates done for Fenelon and for Martinier. The technical report that Brian mentioned earlier, that has been filed and is available to anyone who's interested in getting more into the details, has more detailed tables on the mineral resource estimates for both deposits. As Brian mentioned, yes, the resources have gone down a bit at Fenelon, but our resource grade has gone up at Fenelon. It's remained largely unaffected at Martinier. The big change is with the additional drilling that was done between the last estimate and the end of last year, 20% more drill data at Fenelon and 26% more drill data available at Martinier to inform those estimates. We also, just like the PEA, we've taken a first principles approach toward really looking in detail at the geology and the fundamental controls to the distribution of gold mineralization. And we realized we saw some opportunities to improve the estimates for both deposits, improve the modeling, the geologic modeling, and how we develop the mineral resource volumes to estimate within. And yeah, the net effect of that was less tons, but both systems are still as prospective as ever. It's just, as Brian said earlier, we need to just keep doing more drilling. I see a lot of upside at Martinier still in front of us, and likewise at Fenelon. It's just that's not where our attention is right now. So I'll break off at this point now and maybe turn it back over to Brian.
No, the last slide was a platform for growth, talking about strong technical team, great location, again, ESG focus. So with that, I'll thank everybody for attending and then open it for questions.
Awesome. Thank you so much, Brian, for a great presentation. That concludes actually the presentation portion of the webinar. So I do have a few questions for you, Brian, if you don't mind a bit of a grilling. Perfect. First of all, I will say congratulations, obviously, on a positive PEA. But my first question is, how long did it take you to complete? And this is a question I see reflected in emails too. Could it have been out sooner?
Well, there are two things that reflect that. Yes, we started doing it in the fall of last year. But we wanted a really good cutoff for our resources that go into this study. Because if you look at the last study we did, and we published it in mid-2023, the cutoff was October. We were doing a lot more drilling at that point in time, but there was still a significant amount of drilling that were not in the study. This time, with the smaller programs, we had a good cutoff. In the case of Martinier, all of the drilling completed last year is in our models and our estimates. In the case of Fenelon, I think we're missing 4 holes that were done in the last part of the program, and they would be outside of the resource model anyhow, so it wouldn't impact anything that we've disclosed. So a good cutoff, and I can tell you the team has been working their heart out. They've been going above and beyond, and it just took us this amount of time to get it done. There was no opportunity to start it sooner because we needed all this data to be in the model.
No, appreciate that. And why not do it as a combined PEA with Martinier?
Well, I kind of answered that earlier. Is if you look at the historic drilling, Fenelon historic and anything that Wallbridge is about 600 kilometers. Martinier is 100.5. We need some catching up there. You can see the size of the resource on Martinier. We need to grow that to ultimately come up with a positive PEA. So, that is our forecast. If we try to do something right now, it's too early, and it would not be very helpful.
Yeah, no, fair enough. Appreciate that extra context. One thing, and I know you're certainly not the only company for whom this is true, but why have, specifically for Wallbridge, cash costs increased so much?
Well, there are a couple of things. One, the mining method is, last time it was underground, bulk mineable, similar to a Young Davidson. This one is more traditional, long hole, and, sublevel retreat mining. So it's a little bit different. But we must appreciate that between 2022 and today is 2.5 years in a pretty highly inflationary environment. So if you take what was done last year, add 15% for inflation, it kind of ticks to where we are today. So I am not concerned about that. And the model today is, the team has done a great job with the help of Pierre and Mike. We've really dotted the I's and crossed the T's in our review process.
Great. No, appreciate that. Now, one thing is, I certainly noticed, I think a lot of people did, a pretty big increase in the volume traded before this news came out. Curious if you have any commentary or notes on that.
The only thing I will say about that is there was not a leak. I can guarantee that. There's nothing to do with that. But the chatter was, oh, Wallbridge isn't going to meet their deadline, whatever. And, when I was interviewed at PDAC, I reiterated, absolutely, we're going to publish by the end of the month.
Mm-hmm.
And I think, by the time it got to some of, our shareholders, they finally took notice of it. We're going to hit it. There weren't, being the naysayers. And we hit it.
Sure. No, that makes sense. Curious, and I see this a bit reflected in some of the chatter too. What is the timing on permitting from here?
Well, the way I think this project could go forward is we have a plan for this year. We have our money. And so, starting at December 31st of this year, I think it's a 2, 2, and 2. 2 years to do all the work necessary to complete a pre-fees, start the permitting, start the IBA negotiations, all that stuff, and, get that going. 2 years to complete a feasibility, which include, concluding the IBAs, getting the permits in place, getting the electricity signed up for, and then based on the study, a 2-year build program. So in very, very rough early stage numbers, we need to take some time this fall to go back to the component parts just to make sure that this holds. But based on the recommendations provided by the QPs involved, that seems to be the way we would go forward.
Appreciate that. And I think you touched on it, but I'm curious, what's up next? You starting a pre-fees or feasibility study right away? What are the next steps here?
Well, the next steps is we need to figure out what exactly we need to do to get us to a pre-fees, and that we will be scoped out further between now and Thanksgiving. And we need to find the resources to pay for this. But it's a very exciting project, and our goal is to get out, market, tell the world, help educate the world on how great an opportunity this is. In the meantime, figure out exactly what we need to do to get us to a pre-fees, and then execute.
Great. I know you mentioned it early in the presentation, but this is something I think just bears repeating, so we can have it a couple times in here. I'd love if you could just explain again the rationale on taking the approach to design a smaller mine.
It's from a risk standpoint. We're a small company. We have a small balance sheet. We had to put this together on the basis that if we continue to de-risk it, we may have to build it on our own. And, ultimately, that's what we're planning to do. If somebody comes in halfway through, taps us on the shoulder and says, I've got an opportunity, we think we can do a better job, here's prime plus whatever percent.
Mm-hmm.
We would have to consider at that point that it's not our company. We're the custodians of the shareholders' company.
Sure.
So, there's that. But the whole scenario is based on managing risk, managing the permitting process. Smaller, less surface disturbance is in everybody's best interest. It helps us with closure. It helps us with our First Nations partners. So just taking a top-down risk approach to putting this together.
And when do you anticipate there might be an expansion?
Well, I don't know. It all depends where gold prices are. What
sure.
I'll tell you is that if everything goes according to plan, is built, we hit payback, and gold is at $2,200 an ounce, you may be very happy that you have a 3,000 ton a day plant. If gold prices are still where they are, you would consider expanding it at that point in time. But it all depends where commodity prices are. I've been in this business for a very long period of time. I say this all the time, but I remember when gold was $250 an ounce in the late 90s. And, I don't think we'll ever see that again. But it is a volatile commodity.
Sure.
And that also plays in the risk portfolio to start off smaller and grow it at the right time for the right reasons.
No, appreciate that. I got a strategic question for you. I know we didn't see a rollback with this big announcement. Can investors expect one in the near future?
No.
Great. There's an easy answer. I'll throw it to you, Mark, actually, for the next one. I got one here for you. Could you just generally speak to the changes in the mineral resources at Fenelon Martinier, just so people can get a sense of where your brain's at?
Yeah, no, happy to do that. To get into the details to the technical report, especially the end of section 14, where kind of take a deeper dive on that. But to keep it at higher level, as I mentioned, more drilling, especially infill drilling, it always increases the resolution that you have on your geology, on your distribution of gold grades, etc. And it's a real rarity to see a resource grow in size when you're going into an infill phase. The rule of thumb I've picked up over the years, and I've been in the game, frankly, I think as long as Brian. I won't say how long, but long enough to be able to say that as a rule of thumb, infill drilling, specifically infill drilling, typically, 50-60% of your resource might convert to indicated or stay as inferred. That's just the nature of resource estimates and resource classification. So that's part one. Part two is we came into this this program a year ago, really recognizing that there was a lot of opportunity to really take a closer look, first principles, closer look at the underlying geology that's driving the distribution of gold grades. And, at the end of the day, miners are mining rock. They're getting gold out of it, but they're mining rock. They're mining volumes of rock. And what we've done differently this time was really took a very close look at what are the rock volumes that are carrying the structures that are carrying the gold, which is a little bit kind of looking more at the forest rather than the individual trees. Because again, these gold systems are complex, especially gold systems of this variety. And even at a nominal 40-meter drill hole spacing, which is what we have in the heart of Fenelon, which is supporting the indicated resources, even at that drill hole spacing, it really is tough to link up narrow high-grade structures between holes that far apart. But what we can do, and we see it in the drill core, and we do see it in the data, but just looking at the drill core, what we can do is we can define the overall package of deformed rock that has the collection of those high-grade structures within it. So that's just a fundamentally different approach to the geologic interpretation. The other aspect, I think, and there's a few layers to what's driving these new mineral resource estimates, but another aspect that we really brought to bear and to leverage against our data set was, and working with Mauro Bassotti, who Brian has known him for a long time. I hired Brian, or I hired Mauro when Brian and I were together at New Gold. We really brought to bear some kind of high, I would just say, more in-depth, more sophisticated geostatistical approaches to work with the data sets. When you define a larger volume, you have more samples informing what's going on in that volume, which is a positive thing, and that opens the door to just different approaches in how you estimate what's going on within those volumes. So kind of to sum it up, we tried to strike the right balance between the size of our data sets and the resolution we have in our drill plan as it stands right now, and just what can we realistically interpret in the geology? How far can we project things out along strike or down dip and so on and so forth? So I think, fundamentally it was just, we went back to first principles and brought a lot more geology into this thing, and we leveraged geostatistics, I think, to the next level up.
Awesome, Mark. Thanks. I always appreciate a peek into your brain, so that's really helpful. Brian, I'm going to shoot it back to you. Now the results of the PEA are out. No rest for the wicked. I assume that you and the team are going to be doing a lot of marketing and communications. Any plans you want to share with the folks in the room?
Well, yeah, no, clearly our prime directive is telling the story. Saturday evening, Mark and I are on a plane flying to Zurich for the Denver Gold Show event next week. So we'll start off with that. We're planning one-to-one sessions. We're attending the Quebec Mining Conference in Quebec City in June. We're reaching out to all of the banks out there and brokerage firms to hopefully do desk presentations and, doing some retail marketing in various parts of Canada and the United States. And then one of the one-to-one conferences actually in London. So trying to hit European markets, Canadian markets, and US markets to, tell the good news about the new turning point for Fenelon.
Awesome. No, appreciate it. Now, we have received some queries from investors, came in over email for Brian Fee specifically, wondering how much the stock you own, have you been buying, especially when they saw some pressure to the share price?
Well, I own about 3 million shares. I've bought them, over the years. I have no founder stock. Every share I bought, I went into my pocket and pulled out money to pay for it. I've been blacked out for a period of time here.
Sure.
For obvious reasons.
Yeah.
I will look at what to do from here.
Great. Now, zooming out, and I know it answers to the best of your ability. There's some crystal ball gazing involved, but you are located in excellent company, the project, with some big players. Is Wallbridge open to entertaining offers?
I can't comment on that, but if somebody taps us on the shoulder and they've got a better plan for us, we will consider it.
Sure. No, appreciate that. Last one before I go to some of the great questions that are in chat, which I'll try to get to as many as possible today. We do have a hard stop just at the hour. But what are the company's streaming and royalty commitments right at the current moment?
Well, that's a very, very good question because, the Fenelon project goes back to the 1980s. There are some royalties that have been around for a long period of time. In the study, you can see we have a 4% royalty. 2% is with gold royalty, 1% with Franco, and 1% Eric has. These all go back to the Balmoral days. So we inherited all of these. But you have a 4% royalty commitment on the property. And I believe what's behind that question is, can you, write more royalties to generate cash to advance the project? 4% is probably the upper limit of a royalty you want on a project like Fenelon.
Makes sense. And what is the preliminary strip ratio?
Again, this is a tiny open pit at the end of the mine life. I think it's somewhere around about 3-to-1.
Okay.
But it provides, 12 to 18 months of additional production. And that's why it's at the end of the mine life.
Oh, that's great. And I'm going to jump into some of the questions from the chat now. I know a couple of them were covered specifically while Mark was speaking earlier. So I'll try to go to some of the fresh content. But Bayer from the chat asks, what's the timeline for converting the inferred resources?
Specifically to Fenelon, we haven't set a fixed timeline on that. We're really focused on our program in 2025. But I would think that just looking at Fenelon and the volume we're talking about, we could probably get a fast-tracked infill drill program done in the course of 1 year. That would be multiple drills. Clearly, we'd need to go raise enough money to be able to support that. But right now, in terms of what's right in front of us, a program, and this is just surface drilling from surface, probably get that done in about a year. But piggyback on the back of that would be the need to get underground for reasons more than just infill drilling, but for reasons to really let the miners and the engineers get up close and personal with the rocks, to really start to look at this thing, up front rather than, in sticks of drill core.
Great. Snow from the chat says they may have misheard, but thought they heard a reference to an existing stockpile that could be drawn from for mill feed during ramp up. Curious if we can elaborate on that.
No, the plan is we will build a stockpile during the construction phases that we can draw upon in the first year. So it helps us with a simplified ramp up. We're not turning the key on January 1st of year one and expect to feed it with 3,000 tons a day. We will have the surface stockpile that's generated through the development, because there is some development in ore that will accumulate and be ready to help us. Mining startups have ebbs and flows. It just gives us flexibility in how we start up.
Great. No, I appreciate that extra context. GK from the chat has two questions, so I'll tackle them one at a time. Yes, first, what's the amount of potential upside to resource from today at Fenelon?
Oh, I would say I'm not going to put a number to it, but what I would say is there's a lot of upside, and actually I can address that question maybe even a little bit better. A picture's worth 1,000 words. If we can put slide 11 back up on the screen, I can speak to that, and I think I can get at the.
You know what, Mark? I can't do that because I've shut it off.
That's okay. Yeah. That's all right. This presentation will be on our website. But if you look at the diagram that's on slide 11, for those that want to go follow up, again, the Fenelon project started out on a zone that's called the Gabbro zone, and that was Cyprus, Canada. This is going back to the 1990s and early 2000s. It started out on a little zone called the Gabbro zones. A lot of drilling was done on that. The small open pit that exists out there is on the Gabbro zone, and the reason it started there is because that was what was exposed, sticking its head up above the surface. It wasn't until really not very long ago at all, when after Wallbridge acquired the project from Balmoral. And they started out, stepping off where the last people had left off on the Gabbro zones. But as they stepped back and they started working on, more further afield, they tapped into Area 51. This was in late 2019 with the 51st hole that they had drilled, hence Area 51. When you look at the diagram, and I'm looking over here on my other monitor, you can see that really the whole center of gravity of this Fenelon deposit is covered by overburden. Not real thick overburden, but enough that you just can't see the geology. So, once upon a time, the perception or the knowledge was off to the side, or what is now the side of the Gabbro pits, which when you look at this now, Gabbro is really a satellite to the main event. Fenelon has deep roots. The deepest hole drilled at the project has a very positive hit down plunge of the main contact zone, which is the main high grade zone of the system, 500 meters below the currently defined resource. So yeah, it's still alive, and we're in the Abitibi. All of these gold systems in the Abitibi, for the kind of gold systems that they are, have very deep roots. And when you go look at bigger districts like Malartic or Detour Lake, we're not there yet, but I can't see why, you know, my grandkids might be looking at a big pit or a big mine, you know, here. They all started out as smaller mines, kind of this scale, and look at them today. And, you know, sitting at the chair of the board of our company, Tony McCooch, he's the guy who really first brought that to my attention. And if you just think about it, it's, yeah, you know, this is not all she wrote by any means. And I'm an explorer. I love taking things through their paces and getting them across the line to commercial production. I've done that a few times. But at the end of the day, you know, I'm always looking over the fence. You know, where is that next discovery going to come from? Where are we going to get the new ounces that are going to replace the ones that we've already produced? So that's a bit of a long answer to your question, but there is still a lot more exploration upside at both Fenelon and Martinier, and along the overall trend.
Awesome. No, appreciate that extra context. I think that's great. The second part of his question was, really, he's asking if it seems the strategy is to fund a modest mine at Fenelon, but will the physical plant created set you up to harvest what you find at Martinier as well?
I would say possibly, but you know, only time will really tell. We need to get Martinier more fully fleshed out, as Brian pointed out. You know, there's about 25% the amount of drilling at Martinier that we have at Fenelon. But yeah, you know, down the path, at the end of the day, it's what makes the most commercial sense when it comes time, you know, when you have everything in front of you to make a decision. So, you know, we started out last year thinking we could bring Martinier in. But real quick, we realized, no, there's a lot more than meets the eye to this thing. And we need to just keep moving forward with Fenelon. So we kind of uncoupled them. And Martinier remains an exploration stage project with, you know, considerable prospectivity still in front of it as well.
Great. There's one comment in the chat. He mentions it's a great deposit and a good team. Notes a comment on the financials. It says the contingency is perhaps too low at 10% and should be instead 20% for PEA, noting that the camp size, in his opinion, is too low. Curious if you guys have any thoughts on that.
Well, you know, a PEA is, you know, the overall writing, it's plus or minus 30 to 40%. That's sort of the scoping rules you know, certain components have a 20% contingency, like the mill site, which is where your biggest risk is. And so, you know, like the mining equipment, there's no contingency because, you know, we have quotes on it. So every line item was looked at individually, and it seems reasonable.
Great. No, appreciate that. As well, this is an interesting question. I don't hear this one often, but Dean from the chat asks, has Wallbridge ever explored partnerships or offtake agreements with non-traditional buyers, such as sovereign wealth funds or central banks looking to diversify their reserves?
Well, sovereign wealth funds and central banks, I think, is off the table. We're just not big enough. But, you know, that's the thing that we have to look at, is how do we take it to the next step? And, you know, we have to look at opportunities like that. We have to work closely with the Quebec government. They have incentives for electrifying, you know, equipment and stuff like that. So we got a lot of work to do between now and Christmas to, you know, advance some of these conceptual ideas.
Sure. That makes sense. So we're running out of time, so I'm just going to throw a couple of quick ones at you. EBL consultant asked right towards the beginning of the presentation, I want to make sure we got to them. What is the size of the current portal?
Pierre, do you know that?
Yep. So current portal is 5.5 by 5.5 meters. That's located in the Gabbro pit that Mark was referring to. From there, there's a ramp towards Tabasco with the same dimension of 5.5 by 5.5. And for area 51, it's 4 by 4. Now, in this 2025 PEA, the other ramp we're going to create is going to be a little smaller. It's going to be 5 by 5, which is going to be the dimensions of also the access and haulage levels. And when it's in stope development, those will be 4.5 by 4.5. So smaller equipment again.
Awesome. Appreciate it. Now, I know I didn't get to every question today. I think we did pretty good, but I just got one last quick one. And then all the rest I'm going to send to the Wallbridge team. They'll be happy to answer them for the ones we didn't get to. But I'll end with the question, are the Fenelon gold zones still open at depth?
Absolutely.
Perfect. Love ending on a quick yes. Gentlemen, Brian, Pierre, Mike, Mark, thank you so much for the presentation and for running it through it today. I know there are tons of people in the room. I appreciate all your time. I saw you're all across the world today. So thank you for joining in the chat, asking questions. If you have any follow-up questions, please do reach out. I'll make sure the Wallbridge team gets them, or you can always reach out to them individually. But gentlemen, thank you so much. This was great.
Thanks, everybody, and enjoy your weekend.